Happy Tuesday, y'all. My name is Cedric, and I'm honored to be a guest here on Carter's Finance YouTube channel. Today, I'll be talking about the intersection of strategy and valuation. So an overview of today's lecture is going to be a lot of Columbia influence. Columbia has had a value investing lecture series that has gone on for many decades now. Started with the people who are widely regarded as the founders of value investing, Benjamin Graham and David Dodd. And it's branched on later to lecturers like Bruce Greenwald and Michael Mauboussin. I've read a lot of their works, and I personally found them super persuasive, super interesting, and I hope to share some of their insights with y'all today. So we'll start by looking at basically what competitive strategy is and a common competitive strategy framework. So the concept of competitive strategy originated in the idea that firms do not operate in a vacuum. There are suppliers that they deal with, buyers that they must deal with, and most importantly, there are competitors that they must constantly try to outsmart. There are various factors that contribute to a firm's ability to continue to survive in its industry and grow market share or preserve its existing market share. Porter's Five Forces is a competitive strategy framework that argues that the essence of what gives a company a competitive advantage can be boiled down into 5 different attributes. First is the bargaining power of suppliers, how easily a firm's suppliers can raise input costs. Next, the threat of substitutes, or how quickly a consumer could switch to a competing good outside of the firm's category. Then is the bargaining power of buyers, which is how easily customers can demand lower prices. After that is the threat of new entrants, which is how quickly a competitor firm, like an emerging threat, could come into the market, and how weak the barriers to entry are of getting into the market that the firm operates in. And all 4 of these prior forces that I mentioned feed into the central one known as industry rivalry, which is basically just how much firms within that industry compete against one another to earn profit. There's another competitive strategy framework that's come up recently known as 7 Powers. I'm not going to go into it in great detail for the sake of time, but it's basically the same gist. There are different aspects of a business that drive its ability to either gain and preserve a competitive advantage or lose that competitive advantage. And deeply understanding those drivers can help us assess the prospects of a business in the long term. So before we move on from this background section, are there any questions? Let me look around the audience. Tiffany. That is a fantastic question. And I think that's a great segue into my next slide, talking about bargaining power. So bargaining power refers to the ability of a firm to extract more value out of transactions with counterparties. Now, that's a mouthful, so let's break it down. Extracting more value basically refers to getting better prices, higher prices from customers and lower prices from suppliers so that you can have a bigger profit margin. And transactions with counterparties mean any exchange of goods and services for money between the parties that it deals with. I've already mentioned both of them in this case. It's customers and suppliers, basically. Now, it's not easy to determine which of those 5 forces that I mentioned earlier are the most important. In different industries, different forces are more critical, and experience can help you determine which of those levers matter most. So you'll know, for example, if you work in investing and you're looking at B2B service companies a lot, you'll understand that switching costs are super important. So you'll be examining that barriers to entry, or in this slide, the threat of new entrants, you'll be assessing that really deeply. And for example, if you work in investment research looking at oil and gas companies, you'll understand that it's very critical to understand the input cost of the various commodities that go into oil and gas. So basically, you just need a lot of experience to kind of determine what levers matter most and affect bargaining power the most. And then once you understand that, you'll know what historical data to draw on, what comparable products to look at, what financial comps to look at. And it just flows from there, it just flows from experience. So bringing it all together, as I discussed earlier, there are different competitive strategy frameworks that help you understand what drives a company's success. Now, how do we evaluate, let's just say we think a company has a competitive advantage. What are some indicators that that competitive advantage exists beyond the purely abstract and academic frameworks that I mentioned earlier? There are 2 main examples that I can just think of off the top of my head, although there are many others. The first is pretty notorious. We talk about it a lot in UCIT and in finance in general. It's pricing power, or the ability of a firm to raise its prices without customers leaving. If a company has that, it's a good indicator that there are some strong barriers to entry in this industry, that the company provides something unique that can't easily be replicated. Next is a cost advantage. I'm sure y'all have all heard in econ the term economies of scale before. Basically, it's the ability of a firm to produce goods more cheaply than its competitors, whether due to economies of scale or other types of cost advantages like more efficient technology or a better manufacturing process. The problem that UCITS pitches have historically faced is that we struggle to do this, to bring it all together. We have this discussion about competitive advantage where we talk about our investment thesis, we make these super pretty slides, and we have our financial model where we basically put in equity research projections, slap on a terminal value multiple drawn from a comp set, discount everything back, and then have a price target that's, wherever basically we want it to be. And I think that discussing business strategy in depth and linking it with valuation can help us flow our thesis into our model so that our pitches are a little bit more cohesive and so that we can have models that are more useful than just kind of like something you do as a matter of form. So hopefully in today's lecture, I can help you quantify strategic advantage. Boom, there goes the title card. So my idea for thinking about quantifying strategic advantage actually came from Graham and Dodd, who are like the founders of value investing, like I mentioned earlier, their way of doing segmented valuation. So the way that UCITS typically values companies is that we just look at its earnings power over the next 5 to 10 years, add a terminal value estimate, and then kind of discount it all back. This is something known as a discounted cash flow model, or what Graham and Dodd would call it, an earnings power value model. And basically, it's just a very conservative assessment of enterprise value. However, Graham and Dodd break it down into a more granular way of valuing a company. Instead of just valuing the company in aggregate entirely using only one method, they kind of build this football field of a bunch of different valuation methods so that they can have a variety of perspectives. The first is asset value, which is basically just looking at how much you would get if you liquidated all the company's assets immediately at their market value and then use that to pay off all liabilities. This is usually the lowest value because typically a company is worth a lot more than just, the equipment that it uses. Next is earnings power value, and that's what we basically do in UCITS. We tend to have very conservative assumptions of how much the company will earn over the course of its life cycle. We figure out how much that means in terms of cash flow, and we discount it back to the present. And then finally, Graham and Dodd, they value the growth piece separately. They think about the different growth initiatives the company could embark on. They think about the different areas in which the company could pivot. And then they value that piece as something separately, and adding together the earnings power value with the value of any potential growth initiatives gets you the value of the firm as a whole. And that's typically the most generous value. They want to have a large margin of safety. They want to pay a low price for a high quality company. And I think that when we think about how to quantify strategic advantage, we can apply that same mindset of a segmented valuation. First, we can evaluate the company without a competitive advantage. We can think about if this company doesn't have pricing power, if this company doesn't have a cost advantage, how much would it be worth, assuming no product and cost differentiation. Then we can evaluate the company with a competitive advantage, assuming that its franchise does have value and it can endure over time. And then finally, we can look at untapped potential, or the value of all the untapped value creation levers that the company still has left. I think that with UCITS pitches, we tend to basically have a downside scenario where we look at the company's value if it suddenly faced a significant amount of new competition, its competitive advantage were eroded away. And we also have a base case and a bull case that look at what the company would do if our thesis came true. And our thesis typically hinges on some type of value creation lever being unlocked in the short to medium term. I think that if we were to quantify these thesis points in a more objective way, we could have a lot more precise pitches, and we could have pitches that can generate a lot more conviction in the audience and just be a lot easier to follow. Now, this is all kind of abstract, so I just want to give y'all a bunch of examples to conclude today's lecture. The first one I want to go over is looking at the pricing power of Coca-Cola. So back in freshman year, I had heard all the things that I've just said in this lecture before. Your thesis has to flow into your model. You need to make sure you can quantify the impact of every thesis point on X financial metric, which results in Y impact on the company's valuation. But nothing really clicked until I read this case study that actually was kind of like a mind blower, and it made me realize the power of quantifying competitive advantage and thinking about things in a very concrete, specific way. Basically, the case study asked the reader to pretend as if they were Warren Buffett in 1988 when he first made his investment in Coca-Cola. And it asked you to think about, from that ex-ante perspective, how can you think about the prospects of Coca-Cola going forward? And how can you think about quantifying Coca-Cola's strong brand and its pricing power into a valuation argument for investing? So in this case, the thesis focused a lot on the untapped potential that Coca-Cola had. At this point, it was pretty much a consensus view that Coca-Cola was a very strong company. It had industry-leading margins, had a super popular brand even by that time. But a really great insight into how we can translate those abstract notions of a strong brand and pricing power into a literal quantitative number is by looking at the incremental value that's added by all of these competitive advantages we described earlier. Just looking at, if Coca-Cola added 1 cent to every single one of its cans, how much would it create in value for shareholders? Now, back then, Coca-Cola cans sold at like very cheap, like 50 cents to $1 each. And by looking at how many servings there were in 1988 and doing like a very simple back of the envelope calculation, this assumes zero churn, which might not be the case. I know that Coca-Cola customers were very sticky even back then, but there probably would be some churn. But basically just assuming that we multiply 1 cent, that 1 cent price increase, by the total number of servings, assuming no churn and subtracting out all the associated costs with producing those those cans, we would realize that that 1 cent incremental increase has a post-tax annual royalty of $1.3 billion. So just by raising the price 1 cent for each of those cans, Coca-Cola instantly creates post-tax additional profits of $1.3 billion. And capitalizing these profits into a market cap figure using the Gordon growth formula, we realize that the annuity value of that increase in 1 cent is $11 billion, which was 74% of its market cap back then. Now, back then, granted, there were less institutional investors in public markets and it's easier to make money. It still shows that just by doing some very simple back of the envelope math, by thinking about this company in a very literal way and going step by step, starting from your insights in the company's competitive advantage, thinking about, I think this is a great product. I think there's a lot of untapped pricing power. And then moving into, okay, what if we increase the price by 1 cent? How much would that impact the market cap? And then finally doing the math and realizing that we are creating so much value. That's a really useful exercise. And that's what helped me realize that there is really a lot of merit to trying to quantify these insights. And it is so critical for us to take our thesis, take our high-level insights about a company. I like this product. I think there's more pricing power. Management has stated that they're in a growth stage. They haven't exhausted their pricing power yet. And then quantifying how much value that untapped potential has can yield phenomenal results and help you make fantastic investments, just like Warren Buffett. And also, it can help us on the downside. If a consumer brand loses this pricing power, how much would that damage the brand value? This wasn't included in the case study. It's just something that I thought of on my own. But I just basically took the math from the previous slide and just inverted it. If the price decreased, how much would that impact valuation? And conversely, it was also a massive impact in valuation, which just shows that Buffett was really betting on Coca-Cola's pricing power there. In the long term, after it was done growing, would it be able to continually increase its prices and extract a ton more value that way? And he was correct. And that's basically what drove his investment thesis. And that's what drove the profitability of investment in Coca-Cola. So how can we apply this logic to pitches? This isn't 1988 anymore. This is 2022. And it's not that easy to make money, and it's not that easy to get pitches passed, as we've seen this year. It's tough. GMs are brutal. So you can communicate your thesis using the method I described earlier. Basically, just take every thesis point and think about how much value does that add to the company's market cap if your thesis point is correct. Like basically, how much are you variant from the street and how much value does that add? And just quantify it like that. And we already do this when we input our assumptions into the model. But what I'm asking for is just explicitly labeling this through a variance table. And then after your variance table is done, maybe including some type of diagram like the Moic bridge that I showed down there, which was something that I included in my PE case study that basically showed, okay, this is our original investment, right? This is just assuming no upside or downside. And then here are the different factors that contribute to my upside estimate. And doing this exercise could help us realize, okay, these are the thesis points that matter most. These are the thesis points that matter less. And this is what ultimately drives our investment and what ultimately matters most. And doing that can help us deeper understand which levers drive value and can help us realize that modeling isn't the end itself. It's a means to an end. We use the model to express our thesis. And finally, if things go wrong, we can gauge what's at risk, right? I think something that Jerry Yang, who's graduated now, did super well was that in his pitches, he would make sure that the risks were quantified. Instead of just having risks and mitigants, he would say, okay, here's a risk. And if this happens, this is what our upside would still be. And I think by kind of disaggregating every component of the thesis, every component of the risks page into its own little input in the model, its own little toggle, you can think about the pitch much more rigorously, think about what to focus on more, and realize what matters most. In this case, just from looking at the slide, you instantly realize that the semiconductor shortage is a massive risk, and it actually flips the investment to negative. So just thinking about pitches in this way, quantifying every element of a company's strategic advantage, every element of the value drivers, and kind of building up in that bottom-up segmented way can help us be much more rigorous in the way we think about how to invest. All right, now for some nuts and bolts advice before we close things. So first of all, if you're a sophomore especially, focus heavily on unit prices and costs versus competitors. You might have to do a little bit of detective work. I gave an example here in the slide deck where basically it was during my summer internship, I used a variety of different information from like equity research reports and investor presentations to kind of piece together an understanding of the prices of a software company. It wasn't easy, and I'm running out of time right now, but I can go over that in extensive detail if you'd like. And if any of you are on a pitch, feel free to message me. But basically, you're going to have to get creative, right? It's not going to get handed to you a lot of this information. You're going to have to call around. You're going to have to kind of do a bunch of math to back into figures. And it's very critical that you do this because thinking about the prices is so important to thinking about concepts like pricing power, like cost advantage, that feed into that discussion of competitive advantage I was going over earlier. And then finally, this also goes for sophomores, actually. When you're building a model, remember that sensitivity analysis is king, right? So figure out kind of a defensible set of default assumptions, not quite a base case, but just literally a set of assumptions that say, this is what the assumptions would be if there were no upside or downside. Basically, this is what we believe is baked into the stock price. And then after that, you can kind of layer in the assumptions behind every thesis point and build out a kind of like bridge to upside so that you know these are the different factors that contribute to a business's upside. And even if this never makes it into the slide deck, even if it never makes it into your presentation, it's still a useful exercise for you to understand so that when you're presenting it, you know which aspects matter most, you know what ultimately drives your pitch, and you can present a lot more confidently and kind of defend your ideas in a lot more nuanced way. Instead of having this kind of disconnected debate about abstract concepts like competitive strategy, like the different thesis points, and then having like a separate debate about, like, why'd you pick this number for WACC? Why'd you have these operational assumptions in your model? Hopefully your thesis can flow directly in your model. You can track exactly how it flows, and you can demonstrate to us either by like a Moic bridge, kind of like what's going on there, or via just explaining your thesis much more confidently and quantifying every thesis point, every risk, kind of like what Jerry did over here. All right. So that pretty much wraps up my lecture. If y'all are interested in these concepts at all, I would highly recommend that you check out some of these articles that I have on there. I have kind of a short attention span. I don't like to read full books. So these articles are kind of great summaries of what I said earlier, and they're kind of the inspirations behind what motivated me to do this lecture. I realized that I kind of had to pack things in a little bit, and that I didn't kind of cover things in as much depth as I liked. So if any of this went over your head, once again, always feel free to reach out to me. I'm always down to talk. Always down to, give feedback on any pitches, any ideas you might have. Have a fantastic winter break. Have fun at the Christmas party. Sad I couldn't be there to make it. Bye-bye. Take care, y'all.